Today, we're going to talk about some important facts about stock splits that you really have to know if you trade stocks. So what is it? Simply a corporate action. It's when a company will divide whatever shares exist into multiple shares to boost the liquidity of the shares. So when companies do a stock split, they're essentially offering traders and investors more possible ways to purchase or trade shares at reduced cost compared to before. So when you split the existing shares of a company into multiple new ones, it increases the total number of outstanding shares. So when that happens, it results in an increase in the total number of new shares. But a stock split also reduces each share price to make it more attainable for other traders. So why do they do it? Well, they're pretty common. And the board of directors, they have the power to split the shares. So when they're split, think of it as each share being broken down into a smaller part. So the number of shares increase, the price of each share goes down. And one reason companies might do this is to make their shares more attractive. We talked about that. Make them more affordable. They actually makes it easier for an average trader or investor to purchase the shares. And then it's going to boost the trading activity. So let's talk about Apple. They did a 7-for-1 stock split in June of 2014, and then it reduced the share price from $645 a share down to about $92 per share after the split. So they made the shares more accessible, and Apple hoped that more people would invest in them since they're now cheaper stocks. An increase in trading activity can be great for existing shareholders because it increases liquidity, push prices up due to the increased demand from the bigger market. With heightened visibility because of this increase in activity, institutional investors and traders who may have been put off by the high prices or the low liquidity levels could now be enticed to get involved. Management teams and boards may opt for what they call a stock buyback as part of their financial planning. So it allows existing shareholders to sell back some or all of their holdings at predetermined prices within a certain time frame. So this gives the company the opportunity to raise funds without having to issue new equity or selling additional assets outright, while avoiding diluting the stock base. So basically the primary benefit is that it just renders investing and trading accessible and affordable, even for those who have limited funds. So let's talk about types of stock splits. A forward split is when a company divides its existing shares into more while reducing the price per share to maintain the market cap. So for example, a company has 1 million shares at $10 each. They could do a 2-for-1 forward split. That now results in 2 million shares priced at $5 each. So the total value is going to remain unchanged since the number of shares doubled, but the price was cut in half. So this type of split actually makes the stocks more affordable for smaller traders and can actually signal confidence from management about the future growth prospects. Now, reverse stock splits, that's when the shares are converted into fractional shares. So a 1-to-5 reverse split means for every 5 shares, they are now converted into 1 share. And this will imply that there's not a whole lot of demand for existing shares, so fewer are created. These are actually pretty powerful for companies to manage their stock price and the liquidity. So let's take a little bit further into stock splits. The benefits. We get increased liquidity. We can attract new traders and investors. Viable options trading strategies, lower priced underlying asset makes certain option strategies more viable. And the opportunity for cheaper shares. What are the risks? Increased volatility. Short-term volatility in the stock price could increase following the split. There's a perception of slowed growth. So sometimes these splits, they looked at the company is not growing, could potentially harm a company's reputation, contract unsuitable traders and investors. These are the ones who are not right for the company or just looking for short-term gains. Could be pump and dumpers, you never know. So you really want to weigh the potential benefits against the risks associated with stock splits before you decide to trade around them. It's pretty simple. They can be pretty beneficial for everybody, but it's important to understand the reasons why companies decide to do it, as well as the different types of splits out there before you trade them or invest in them. And now there are some potential dangers. We talked about those, but those who understand the process and they do their homework can actually do pretty well by exploiting these chances when they occur. So you got to understand the process, and you can actually maximize your returns by taking advantage of these opportunities. And trading stocks directly, some people like it, some people don't. A lot of people go the options route. We have a cookbook here. It's called the 8-Minute Options Trading Cookbook. It's got some pretty powerful strategies in it. It's totally free. The link is to the left here or below. Inside this guide, 5 different paths to success on every single trade. Check it out. It's free. We'll talk to you soon.